Tax professionals treating pandemic-era refund claims as routine tax preparation are stepping into a trap. These filings are highly contingent, protective litigation staging. Handing a client your standard Form 1040 boilerplate engagement letter for a Kwong matter leaves you entirely exposed. Relying on a general tax prep agreement actively invites Circular 230 violations by failing to document the specific risks and limitations of the representation. Generic wording also strips away your defenses against Section 6676 preparer penalties and opens the door to malpractice claims. To survive the scrutiny of the courts, your engagement letter must explicitly code for the strict rules of the variance doctrine. It must legally separate the statutory timeliness clock from the allowance look-back period, and it must force the client to acknowledge in writing that the Federal Circuit could prospectively invalidate the entire legal theory. Implementing a specialized Kwong engagement letter is the only way to document the risk disclosure required to defend against a professional liability claim. The first pillar is an aggressively narrowed scope of services. As outlined, you must identify the exact periods and services to be rendered. Relying on general phrasing creates an undefendable liability. Promise a blanket outcome, you own the consequences of every form filed. Instead, isolate the representation to one of three distinct pathways for pandemic refunds. Pathway A covers safe penalty abatements, while Pathway B deals with amended returns. Pathway C carries the highest risk, involving filing original returns to claim the recovery rebate credit for non-filers. The danger here is structural. Filing an original return to claim that credit officially starts the IRS assessment clock. If the underlying tax the client actually owes exceeds the credit they are claiming, your filing just exposed them to failure to file and failure to pay penalties. Therefore, the engagement letter must physically isolate your firm's representation strictly to the filing of the protective claim itself. You must explicitly disclaim any responsibility for underlying net balances, subsequent examinations, or unintended assessments. Defining the scope with this level of precision prevents the client from holding your firm financially liable for a sudden, unexpected IRS tax bill. Next, the contract must address the variance doctrine. This requires predefining the exact legal theory your firm will argue. The rule is absolute. If you fail to raise a specific statutory theory at the administrative claim stage, it is forever foreclosed in litigation. To understand this trap, observe two timelines representing the rules of Section 6511. Public Law 119-64 stretches the look-back window further back in time, ensuring the refund is recoverable, but it does nothing to the timeliness clock. Surviving the timeliness deadline relies entirely on a highly contested reading of the Section 7508AD extension, a completely separate legal mechanism from the look-back fix. Your engagement letter and the subsequent cover letter sent to the IRS must commit to pleading these as two completely independent statutory arguments. Contextually locking down this dual clock strategy guarantees the administrative record is properly staged to survive a variance doctrine dismissal in court. This entire strategy rests on a precarious foundation, a strict textualist reading of the law originating from the Court of Federal Claims. The Internal Revenue Service is actively fighting this interpretation and has officially refused to acquiesce to it. The defining case for this theory, Kwong, is currently sitting on appeal at the Federal Circuit. Because the Federal Circuit reviews legal questions de novo, the entire underlying theory could be invalidated instantly. Your engagement letter must ruthlessly strip away any implied promise of a successful refund. The client must acknowledge in writing that the position is highly contingent and could fail prospectively based on the court's final ruling. Shifting this appellate risk to the client via written consent protects you from failure to deliver lawsuits if the judicial outcome favors the IRS. Beyond client lawsuits, this practice area presents a direct financial threat to the tax professional in the form of preparer penalties. Because the IRS aggressively contests these Pathway C non-filer claims, an erroneous refund filing triggers a 20% penalty. Avoiding this penalty requires you to submit a specific 6-element disclosure that establishes reasonable cause and good faith. The contract must explicitly stipulate that your firm is authorized and required to draft and submit this exact disclosure alongside the claim. Finally, the letter must close a critical Circular 230 loophole regarding file ownership. It must state that all legal analysis, tax research, and supporting work papers belong exclusively to the firm, not to the client. Retaining legal ownership of the reasonable basis documentation ensures the firm maintains the evidence required to defend its own practice during an IRS oversight proceeding. When fully assembled, a properly drafted Kwong engagement letter operates as your tax practice's absolute primary defense mechanism. Operational safety requires narrowly identifying the client and locking down the exact filing pathway. Strategic safety requires explicitly separating the statutory clocks to satisfy the variance doctrine. And financial safety requires shifting the looming appellate risk entirely back to the client. To survive this doctrinal minefield, you have to execute the contract first before you can safely execute the law.